Abercrombie & Fitch was founded in 1892 in New York City. They were founded as an outdoor store, but they have quickly developed into a leader in the retail market, with really leaning into size inclusivity in the most recent years. The rebranding of 2017 has really become a gold mine for them, and their current net worth is $6.92 billion. Although the pandemic did really affect a lot of retailers, Abercrombie was able to weather the storm. In 2022, Abercrombie & Fitch recorded a 38.91 days outstanding receivable and a 35.23 days of inventory turnover. Although industry-wide averages were not readily available, these figures illustrate Abercrombie & Fitch's ability to manage receivables and inventory when compared to its competitors. The total asset turnover ratio shows Abercrombie & Fitch's ability to effectively generate sales. From its fiscal year of 2022, Abercrombie & Fitch achieved a total asset turnover ratio of 1.3, surpassing the industry average of 1.18. This indicates Abercrombie & Fitch's ability to lever its asset base to drive sales, potentially outperforming competitors. This trend has persisted since 2012, indicating Abercrombie & Fitch continuously focuses on optimizing asset utilization to enhance revenue generation. Finally, Abercrombie & Fitch's profitability through the return of equity, ROE as we call it, ratio unveils its ability to generate shareholders' returns. In 2022, they achieved a ROE of 0.4%, significantly lower than the industry standard, indicating Abercrombie & Fitch comparatively. Finally, assessing Abercrombie & Fitch's profitability through the return of equity ratio unveiled its ability to generate shareholder returns. In 2022, Abercrombie & Fitch achieved a return on equity ratio of 0.40%, significantly lower than the industry average of 31.43%. This indicates that Abercrombie & Fitch compares weaker profitability than other companies in the industry. This makes it necessary to implement strategic measures to enhance shareholders' value and improve earning capacities.
Abercrombie & Fitch has made its mark with trendy clothing and lifestyle items. The company's success is dependent on many elements that affect store profitability as it competes within an active market. It must keep up with changing consumer preferences, deal with economic ups and downs, and competition from other retailers. Abercrombie & Fitch's capacity to provide great experience for its customers is crucial to keep profitability stable. The company's focus on improving its products and customer experience helps to maintain market position. Abercrombie & Fitch competes directly with other clothing retailers that market to similar demographics and sell similar products. These companies include American Eagle Outfitters, Hollister Company, which is a part of Abercrombie & Fitch, Gap, and H&M. In the past few years, Abercrombie & Fitch has changed its brand significantly. They shifted from a more conventional image of too much branding and exclusive clothes to one that is open-minded, diverse, and concentrates on modern styles for a wider variety of customers. This change in strategy played an important part in keeping Abercrombie & Fitch up to date and attracting new types of shoppers, as evidenced by a 15.8% revenue increase over prior year. Abercrombie & Fitch's capital structure outlines how the company funds its operations and investments through a blend of equity and debt tools. Examining the components of its capital structure provides valuable insights into Abercrombie & Fitch's financial framework and risk management strategies. Abercrombie & Fitch's equity component is characterized by its common stock. The company's share price is currently valued at $146.77 per share, with 4,814,192 shares outstanding, resulting in a market value of equity amounting $706,569,000. This represents approximately 39% of Abercrombie & Fitch's total market value, indicating the significant contribution of equity financing to the company's capital structure. Conversely, Abercrombie & Fitch relies on debt financing to support its operations and growth initiatives. The company's total debt is $1,104,331,000. Constituting approximately 61% of its market value. This highlights the substantial portion of Abercrombie & Fitch's capital structure financed through debt instruments, showing the company's utilization of leverage to add to its financial resources. Given the trend depicted in Article 1.5 of the appendix, Abercrombie has a strong current market position and appears to be on a continuous upward trajectory. Price per share has doubled over the span of 5 years and is at an all-time high since Abercrombie became publicly traded in the early 2000s. Abercrombie & Fitch's global net sales have grown at an average rate of 6% year over year for the last 5 years. In this era of digitization, maximum sales have come from its physical storefronts, which constitute 70% of the total sales, and the remaining 30% was from online sales. Their vision for 2017 through 2022 was to sustain and transform their sales and operating margin. For 2023 through 2025, their focus is on more sustainable and profitable growth. Beyond 2025, their long-term vision is to achieve yearly net sales of $5 billion while consistently maintaining an operating margin of 10%. The brand has increased its presence in almost all major markets worldwide, with Americas being its major contributor to growth. Over the recent years, the brand's operating profit has risen constantly, with the exception of 2020, due to COVID-19, which caused it to suffer a loss. Abercrombie & Fitch should try to focus more on accelerating their digital presence. They should consider investing in customer analytics to improve their customer engagement, and they should also focus on continuing to invest in people, systems, and processes to improve their end-to-end customer experience. Additionally, they should try to use the benefits that a data-driven approach could give them in every field of their operations, whether it be marketing, manufacturing, entering new markets, expanding SKUs, etc. They should operate with financial discipline because their operating expenses constitute around 53% of their total costs, which generally is high. Lastly, they should try to enter new markets and broaden their target sales audience.